Stocks are climbing this morning, even as Treasury yields rise and global uncertainty keeps investors uneasy. That combination usually hurts equities. Today, at least so far, it hasn't. US markets opened higher in the latest session, pushing against a backdrop that would, in most circumstances, give buyers pause. Treasury yields have been moving up in recent weeks. Geopolitical tensions remain elevated. Neither condition is typically friendly to stocks, and yet buyers stepped in at the open. To understand why this matters, it helps to know what rising Treasury yields actually do to equity markets. When government bonds pay more, investors can earn a decent return without taking on the risk of owning stocks. That makes bonds more attractive and stocks comparatively less so. Money tends to rotate out of equities and into fixed income. The fact that stocks opened higher despite yields climbing is a signal, not a guarantee, that investors are still willing to carry risk for now. So why are yields rising in the first place? A few forces are at work. Questions about US fiscal policy have been building. Inflation expectations remain stubborn, meaning investors are not fully convinced price pressures are gone. And economic data has been strong enough to push back expectations for Federal Reserve rate cuts. When the economy looks resilient, the Fed has less reason to lower rates quickly. That keeps yields elevated. Higher yields, in turn, raise borrowing costs across the board, on mortgages, corporate loans, and government debt itself. On the global side, the picture is complicated. Geopolitical tensions in several regions continue to cloud the outlook for trade and energy prices. Markets have sold off sharply at points this year when those tensions flared. The current tone is cautious optimism, but that can shift quickly if something breaks the wrong way. Whether today's early gains hold will depend on what else comes across the tape. Fresh economic data, commentary from central bank officials, or any development abroad that changes the risk calculation. The deeper tension here is one investors will be navigating for weeks. Yields and equities are pulling in opposite directions. For now, equities are winning that tug of war, but a sustained move higher in Treasury yields, not just a spike, but a grind higher, could eventually become harder for stock markets to absorb. The practical read: watch the bond market as much as the stock market this week. If Treasury yields continue rising and equities start to crack, that is the moment the dynamic shifts from resilience to vulnerability. One market is sending a warning. The other is choosing to ignore it, at least for now. This briefing is brought to you by First Financial News, clear, daily coverage of the economy and markets at firstfinancialnews.com.